We're back on Morning Movers. We'll get another look at the semiconductor space after today's closing bell when Texas Instruments reports its second quarter earnings. Analysts are expecting adjusted EPS to come in at $1.32 a share on revenue of more than $4.3 billion. Shares are up 14% this year and more than 50% off the April's low. It's time now for Options Corner, and joining us to take us through a deeper look at Texas Instruments is Rick Ducat, lead market technician. What are you seeing, Rick? Good morning to you.
Yes, good morning. And, we can see Texas Instruments stacking up against both its own sector and the S&P 500 is coming up a bit short here. S&P and tech, or excuse me, SMH and tech here kind of outperforming this particular indicator here. But now we can see here, if we were to look at our chart here, we can see that price is getting a bit stretched perhaps. We got stuck at our previous highs near 220. Now price is giving back a little bit of those gains that we saw, passing below this volume node and below our +2 standard deviation channel. So potential support could start coming in around this area. 200 to 205 represents our 63-day EMA, our point of control and our volume profile, and our +1 standard deviation channel. So quite a bit of potential support in that area.
Okay, great stuff. And what stands out as far as the options market is concerned when you look at open interest and volume?
Sure. Yesterday's volume, mostly from now till September, October was the date range. Call side, 210 to 240. Puts, 180 to 215. One notable trade I saw was a trader bought 545,000 of the August 15th 210 calls, so a bullish opening trade it appeared. But if we were to look at open interest on the call side for August, 200 to 250 is the range. 220 was where things come in the highest. Our expected move is about 191 to 232. So some interesting boundaries there. On the put side, we can see it's the range 165 to 210. Highest at about 200 or so. So that 200, 220 general level really stands out for this particular symbol.
All right, those are the key levels to watch on Texas Instruments. Thanks so much, Rick Ducat. Really appreciate it. Now to take us through an example trade is Tom White, senior options contributor. Very good morning to you, Tom. How would you set up an example trade ahead of today's earnings?
Well, implied volatility levels are elevated going into this report. The option market priced in about a plus or minus 4.5% move, or about $10 either way. Stock settled just about 3% below those all-time highs yesterday. So the optimism's pretty high and the bar's pretty high into this one going into to results. So with that pullback that we're seeing this morning ahead of the open, it's probably based on the fact that NXPI is down post earnings. They rely a lot. Nearly 2/3 of their revenue generation and profitability is based on the automotive sector. So that's not a good sign for Texas Instruments. So I looked at a strategy that gives me exposure to the downside, about that 1 standard deviation move, but it gives me exposure at a really low cost entry point. So I looked at a really short-term 1 week wide put calendar to the downside here, where I'm going to go out to the August 1st weekly options, expires in 10 days. Buy the 200 strike put. That's going to be about $10 below where the stock's going to open up here, around $211. And then I'm going to sell that same 200 strike put in the near-term July 25th weekly options that expire in just 3 days. So a 1 week wide bearish put calendar to the downside. I'm going to pay roughly about $1 debit for it. So there's my risk, $100 per spread on this one. Now, where do I want the stock to go? Well, I want it to go at or near that 200 strike. But you can see here from the risk profile, I've got break evens between about 190 on the downside, maybe about 208, 209 on the upside, where I can still be profitable on this type of trade. Now, what I don't want to happen, I don't want the stock to go up. I want the stock to grind lower, and I don't want the stock to go 2-3 standard deviations down, maybe move a $20 or $30 move to the downside, because I start losing on that end. But this gives me some exposure to the downside. Now, why is it only worth, or why are you only paying $1 for this type of strategy? Well, you're only buying about a 50% implied volatility on aggregate in that August 1st weekly 200 put, selling about a 70% implied volatility in that near-term July 25th weekly options on that same 200 strike put. So that vol dispersion lowers the price entry point on this bearish trade.